If you're joining us now, you're watching our live coverage of the South African Reserve Bank's Monetary Policy Committee meeting. It's just been concluded. The governor has told us the committee has decided that it will not change the repo rate at this meeting, and that they expect inflation hopefully to continue tending lower going into the future. So let's get into the analysis and the reasons behind the decision that was taken. Joining me for this conversation already, you have seen her, Annabel Bishop, Chief Economist at Investec. We're also going to be joined by Goolam Ballim, his Chief Economist at Standard Bank Group, and Carmen, Head of Multi-Asset Strategy at Terebinth Capital. Goolam, if I can start with you, I wanted to know if you are convinced by the reasons that were given by the governor in coming to a no-change decision today, and also whether that was in line with what the big brains at Standard Bank had in mind.
So indeed, we had suggested, especially after yesterday's CPI data, that the odds had shifted into the Reserve Bank remaining idle at this engagement. I think we must acknowledge that in recent weeks, there has been a decided turn in tone globally with regard to what was previously persistent and sticky inflation at both a producer and at a consumer inflation level. And monetary policy substance around the world, also in many key markets, especially the United States, also tilted towards some level of moderation from the earlier hiking cycle. Locally, as we've just highlighted yesterday, CPI data was on balance favorable, especially with some metrics like processed foods pointing lower in some respects. So I think that any hesitation would have been around inflation expectations, which when looking through the rear view mirror remains elevated. But these are adaptive, and to the extent that inflation has fallen or disinflation is well in train with milestone figure yesterday, I think inflation expectations similarly will subside in due course. So I concur with the Reserve Bank's decision, but I also subscribe to the earlier remarks that the governor himself was probably personally postured towards tightening.
And we get, I guess, into that area where we discuss again, like we did after the U.S. Reserve Bank's last decision, which was a pause, whether this is going to be a pause or perhaps we're going to see the MPC return with another one if warranted. Goolam, I'm still with you.
So in the Q&A session, when asked if this is the zenith of the rate tightening cycle, the Reserve Bank governor responded by saying, and I quote, resounding no. But he then went on to talk about incoming data, which was, of course, sensible. But I think that resounding no just speaks to the tone of orthodoxy. It speaks to what the governor has highlighted previously in the sense that he would rather with over tightening and then releasing from that pinch sooner than belatedly having to tight and cause monetary policy to remain even more elevated for an extended and more economically damaging period. So that's the governor, that's the way he's built. My sense is that to the extent that the rand has recovered handsomely from the Lady R matter, to the extent that relative rand strength prevails, and over the next 2 months or so, inflation, at least supply side drivers, continue to improve. I suspect this could be, in fact, the peak, the zenith in the rate tightening cycle.
Indeed. Let's hope Lady R or her kind of shape does not return to our shores again. Carmen, if I can have your take as well on whether perhaps the governor, while being very cautious, still may have indicated that this could be the top. And also, I wanted to know in terms of the decision, we're running our own little poll with you as well, whether this was what you expected.
So in terms of the expectation, we thought it would be a very close call. We did side with a 25 basis point hike, but we thought there'd be 2 members voting for a pause. And to show how close it was, there were 3 members that voted for a pause and 2 for a cut. So certainly not a dovish outcome at all. Similar to Goolam's sentiments about the explicit answers given now in the Q&A that this is not the peak. I think what is crucial is we have to acknowledge that there are a lot of competing forces on the Reserve Bank. And I think the Fed pause and the recovery in the rand gave the Reserve Bank breathing room. If the Fed resumes its hiking cycle, which is what the Fed minutes suggest, then we could see renewed pressure on the currency because of the interest rate differential. So I think it's not just data dependence, local data. It's also about whether global central banks are close to peaking. But even from here, it might be one more hike. It's certainly not sequential hikes that you have to look at on the upside. But the debate certainly in the market's now going to shift firmly to the timing of the first cut.
Absolutely. And when you look at the closeness, well, I suppose it had to be closed if you have got 5 members and you get a 3-2, but it is close, isn't it? Are you surprised by that closeness, or do you think perhaps this was more a matter of the final decision being the more important thing other than the actual numbers in terms of the voting that we saw?
Well, I think the voting just highlights that the SARB is still somewhat concerned about the risks, all the uncertainties out there. But I do think we're probably at the peak in the sense of looking at from a shorter-term perspective, inflation is coming down. I think the question more in the medium term, which will again speak to the cuts, is how sustainably this low inflation will be, or whether the data we've seen globally is really just a base effect coming through, but that further out inflation could, start climbing again for various reasons. Annabel highlighted, the global warming or climate. Locally, again, we might face lagged FX pass-through. So yes, the rand has recovered, but it's still not a strong currency. So there could be some pipeline pressures there that we just have to be cognizant of in terms of risk management. So again, broadly speaking, we probably at the peak, but given how high and fast real rates have risen, in SA, yes, granted narrowing inflation or real rate differentials with, for example, the US, there's a lot of tightening in the pipeline that the SARB maybe this time around was a bit more aware of. So you had the 3 members voting for the pause.
Yeah. Annabel, I can't remember whether what you told me about whether this is it for the year or perhaps there's another increase was before we went live or after we went live. So give me your thoughts again. Is this it in your view, or are we likely to see perhaps one more should the Fed do one more?
We continue to expect that this will be the peak, the terminal interest rate. No more hikes from here.
475 basis points is a lot of pain, I have to say.
It's a lot of pain. And, I agree with what my colleagues have been saying. But also, of course, as well, households are extremely financially vulnerable. There's a huge amount of consumer pain. And, of course, there's a 2 to 3 quarter lag at least of the higher interest rate effect coming through on the economy and, of course, on inflation, which means, Godfrey, it hasn't actually all come through yet. So we are still going to benefit for the next few months from the suppressing effect of higher interest rate hikes on inflation, irrespective of whether we hike today as well or not. So that point of view, I think really, brings us to mind that we've already seen pain in the consumer market. We've already seen the impact on demand-led inflation. I think from a global perspective and a domestic perspective, we benefited particularly from food price deflation. Right. If you look at food prices at the agricultural level, but also, of course, as well, other commodity prices. That brings into account base effects. Look, I know when we obviously import oil or when we petroleum products or when we sell commodities overseas, there's also the impact of the rand that comes through. And of course, rand weakness has a big effect. Interestingly, if we were to look, where were we with the rand last year in the first quarter? We were at 14.50 to the US dollar. So we think,
there's a lot more that we need to recover.
To regain. We think 17.74 today was a good outcome, but actually, we're still a couple of rand off where we should be. And, that's our fair value view, that the rand should be closer to 14.50.
Absolutely. Before we talk about the future, I just wanted again, so that rand, that dollar price that you're talking about, 17.98 is that number now. Obviously, there will be a lot of volatility because of the decision that was taken today. I wanted to share with you and Goolam and Carmen the results of our little poll that we ran on Twitter, where we were asking if they thought the bank should hike or they shouldn't. So the question was, has the 475 basis points that have been imposed been enough, or the bank should pause? So those who said the bank can continue hiking were in the minority. No surprises there. It's on screen, 18.2%. And then those who thought, no, inflation has cooled, were 41.8%, the majority in terms of the overall numbers that we have. But there's also a big number for the cut brigade please. Annabel, when you look through this result that we saw from the SARB, what would you say was the tipping point here, or tipping aspect? And I am restricting it, and I know what I'm doing, I'm restricting it to pressure on households, the lower inflation number that came in lower than the market expected, and the strong rand.
So
Relative, June, July.
So I know you won't like the answer, but for the SARB, it would have been all of them. But if you want perhaps one that's bigger than the rest, you know, the Reserve Bank governor himself did say that the inflation rate, CPI inflation, which is what we target, we don't target core, came back within the target range this month. But also, of course, as well, next month, you know, coming out at 4.5%. That's quite key. Look, I think my surprise again is the fact that the inflation forecasts are so high for next year. So, you know, maybe the inflation wasn't the big tipping point because they run on the inflation forecast, which informs their interest rate view. Yes. So perhaps for them, the tipping point might rather have been, you know, either the currency or the household pain. I think, you know, the Reserve Bank obviously keeping a very close eye on households. Let's not forget the financial sector as well. There are concerns coming through from the banking sector about people being able to service their mortgage advances, their loans in general. And I think, you know, from this perspective, you don't want asset-backed finance starting to crash out. We've had such a strong and quick interest rate trajectory globally as well as domestically. We're more used to it in South Africa than, you know, the advanced economies, but it doesn't mean that more pain is not going to come down the line. So, you know, for me, it's very much about the impact of interest rates. You know, you can't continue to keep hiking blindly. And as we know, our governors, you know, very intelligent, and I think our Reserve Bank governors, all of them, deputy governors, all of them, and I think, you know, that they probably did feel that at some point we need to just wait, we need to see how has all the interest rate hikes actually affected the economy, because there's no way as the impacts come through. Even if we don't hike or change interest rates until next year, there's still going to be effects coming through on inflation.
Then the debate, of course, shifts to the restrictive nature of interest rates and for how long that this will be maintained. I think the governor did try to answer that question, but I wanted your thoughts in terms of how much stricter, for how long, and then also tie that to their inflation forecast that you were talking about, and whether that ties in with you, because that in part answers the question around how much longer, isn't it?
Look, for me, it's very much about the rapidity of the fall in inflation. So how quickly do the CPI inflation figures come off? As we've said a number of times, our view is quicker than that of the Reserve Bank, which means that we're going to have a tightening in our real interest rates. Real interest rates are going to go up. And from that perspective, we do think there's room for interest rate cut, at least one cut next year. We think we might even get two. And, you know, we are in a situation where if, you know, you suddenly see inflation move back to 4.5% next year, and average around 4.5% next year, then the Reserve Bank, as they say, the data changes, their view will change quite quickly, and of course so will their interest rate view. Look, also as well, we do have the global expectations led by the United States, and they have got interest rate cuts factored in by the financial markets at the moment to the implied Fed funds futures. And I think that's the way that, you know, it's being viewed at the moment. Restrictive monetary policy this year, and then from next year easing.
Goolam, in your calculations and your modeling, does the cut, the conversation around a potential cut feature at all? Goolam, I think you're muted.
Okay.
There you go, yes.
I'm broadly aligned with Annabel to the extent that we do believe and subscribe to the notion that interest rates can probably begin to subside early next year. But I would just inject into that conversation the notion of what can go wrong. Heightened geopolitical risk we have to consider. The Fed will be hawkish and remain postured in that light, premised on inflation risks in that market. In South Africa, of course, we've got a political cycle that could continue to inject an elevated risk premium. And even though I also wouldn't digress markedly from Annabel's fair value for the rand, I think that fair value for the rand will remain remote for the next year, given, as I've just suggested, the political cycle could weigh heavily. And to that extent, that speaks to rand risk and commensurate concomitant inflation risk. So I think while we can project that we are at or near the top of the cycle, while we can broadly suggest monetary policy easing from constricted levels early next year, the month to month and the extent to which the Reserve Bank will just remain guarded will be the subject of debate and driven by not just macro or narrowly inflation path, but geopolitics and domestic idiosyncratic political dynamics as well. So it's a busy and convoluted period ahead with no single data point, but an accumulation of data points that's going to keep the Reserve Bank very gripped.
Yeah. Goolam, you have watched the South African economy, of course, for a long time. Have you seen any correlation between South African monetary policy and the political environment? You brought in the aspect that, of course, we've got an election coming up next year. Traditionally, in other countries, we have seen spending increasing ahead, that is on the government side, ahead of elections. How big is that risk?
No, look, certainly the risk of an expansionary monetary fiscal stance, or even if it isn't in the sense of an overt expenditure program, but in the subtleties of the way government allocates funds. And of course, we're already beginning to see populism emerge, at least at provincial level. So that will be core, especially in an environment where the ANC, for the first time in nearly 3 decades, faces falling below 50% at a national level, and of course forsaking 2 very significant provinces in the form of Gauteng and KwaZulu-Natal. But that aside, I suspect that the Reserve Bank will be pretty independent in the way it scripts monetary policy. The Reserve Bank will not release interest rates, or at least lighten the monetary policy load sooner than it believes necessary. So I don't think, back in the day we had what was famously called the Primrose Prime, local by-election in Primrose, and the central bank governor getting a call from the government to lower interest rates and duly doing that. And I know many listeners, many viewers will be unaware of that era of monetary policy making. So I think there's been a very substantial maturity in monetary policy and independence, some very safely safeguarded.
Indeed, indeed. I wonder, though, if the governor ever gets that call. So maybe one day in our other engagements we'll ask if he ever gets that call, but I won't report about it. Carmen, would you concur? There's little risk here that the bank could fold into political pressures. And then I wanted to take the discussion a little forward and ask you to put on your other hat around asset management and ask whether this is the time now to heavily weight South Africa versus what we have seen lately.
Yeah, so just on the politics, no, certainly the Reserve Bank is very independent, and sort of sometimes you think the governor will hike rates on purpose if people are telling him to cut rates, so they must be careful what they wish for. So on the asset management side, so if we think about sort of broad asset allocation, market pricing has been such that, it is thinking of this as the peak. The question really now is, do you overweight aggressively interest rate sensitive sectors on the expectation of rate cuts? And this is this debate about, yes, they may be able to start cuts early next year. So on average, the pause after a hiking cycle is roughly 10 months. So we can pitch the first cut maybe for March next year, but isn't going to be a substantial easing cycle. So we've had a lot lower inflation volatility over the last, call it 10 years compared to sort of pre-global financial crisis. So that has also translated into generally lower monetary policy cycles in terms of magnitude. Granted, this was a very large one, partly because of the global cycle. So I think that's sort of where the market's going to start shifting towards. Certainly from valuation perspective, there's definitely a case to be made to be overweight South Africa. Valuations, if you look at equities and bonds, are cheap. Even listed property is competitively valued. But then the debate comes in around the rand, really, is would you have a strong home bias if you think the rand is vulnerable, or if a fair value of something like 14.50 to 15 actually comes into play, then yes, you would want a strong home bias, because obviously a recovery in the rand would hurt your offshore allocations. So I think that it might be a bit early, just because we still need to see what the Fed's going to do. It's not obvious that the Fed's going to pause again. But if this is in the peak of the cycle, then yes, now is the time to start shifting towards those interest rate sensitive sectors. But with the caveat, as was noted in the prior discussion, is that the growth slowdown related to past monetary policy tightening is still to be fully felt. And I think we have to overlay that with the fact that our terms of trade has weakened, and that's still going to come through the fiscal channel, in 3 to 6 to 9 months' time. And that may also have consequences in terms of domestic demand and demand-sensitive sectors.
Your comment on the bonds is interesting, because in the morning we had this email coming through from Bank of America, their South African fund manager survey, and they say that investors are the most bullish on South African bonds since 1999. That's how cheap they are. Annabel, I want to shift the conversation to a little bit of politics again, but also come back and talk about how deep this cycle of that we are expecting going forward on easing is likely to be. How much do you keep an eye on the possible scenarios for the election come next year? I'm asking the question because I think many people are suggesting that the ANC could likely lose power next year to a coalition, perhaps the one that's being touted by the DA or perhaps some other formation. But to what extent is that a risk for these outcomes that we're talking about here today?
Yes, so I look at it very closely. I think, because it helps us with the RAND, it helps with the other forecasts.
Yes.
We are definitely of the opinion that the ANC is at grave risk of losing more, from a...
Power nationally?
Yes. More votes,
Okay.
more percentage. It's at grave risk of coming out with a lower outturn than it did at the last time, and that of course was the municipal elections.
Yes.
So, where we find ourselves is that the ruling party tends to do poorly when the economy does poorly, and we've now had over a decade of that with not much improvement. In fact, you already saw the angst and misery with the increased schedules of load shedding, worries about stage 8 even, and how the ANC reacted so fast.
Yeah. Put
in an Energy Minister Ramakgopa, who's actually done fairly well, but of course there are still issues on the electricity side we can unpack another day.
Yeah.
The point really is that if the I think I heard that the EFF says will even join the DA, and is it called the Moon Pact, or what is the pact called? Moonshot Pact.
That's
it, yes. Yeah, to try and oust the ANC. So it still seems to be quite wide open.
Yeah,
I
it's
don't
fluid.
Think it's fluid. It's very fluid. But let's say the ANC goes into a coalition just with the EFF, like it has done in some municipalities, particularly in Gauteng.
Yeah.
That would create huge investor worry and concern on a swing to the left. And many of the ANC's policies already are quite left. You look at the nationalisation of the private healthcare sector under the NHI, the expropriation without compensation bill. It's likely to see signed into being now by the president quite soon. A number of other policies as well. They're looking at whether it's water, all sorts of issues about more ownership of government of private sector areas. So that's where we find worry for the outlook for the rand and for financial markets, because that tends to be a negative from a financial market perspective. If you're looking, your other question was on the interest rate cycle.
Exactly.
We're around about 1% in terms of the total cut in the interest rate cycle. Only because we find ourselves, coming from a very low base. Remember, the prime rate is at 3.5% under the COVID lockdown restriction years. And if your inflation rate is at 4.5%, if you believe, and we believe more strongly than the Reserve Bank does, they'll achieve their target over the next few years, then your neutral level, your real interest rate, your neutral level tends to be maybe 2.5% above that, and that really takes you to 6-7%. If we're at 125 now, we think we might get a cut of 125 basis points in the cycle in total, spread out over a few years. We don't think it's going to be quick, and we don't think it's going to be lumped together.
Oh my word. Goolam, would you agree?
I anchor again with my colleague. It seems like we're singing from the same hymn sheet. I think you must recall that at 3.5%, that was, almost call it artificial. It was exceedingly low, and in fact, the repo rate has more than doubled. But having doubled, as I'm suggesting, it's come from an incredibly precarious level. It was largely function of the exceedingly acute COVID-19 shock. And in that respect, I don't think we should regard the starting point as representing perhaps a normal cyclical path. So modest cuts early next year is likely to be mainstream as we drift towards 4.5% over the ensuing quarters. But the notion, for example, that there may be 2 or 2.5 percentage points worth of interest rate relief portending would be a misread in suggesting, or at least in attempting to hinge prospective cuts to where we started.
But Goolam, where would be normal? Where would normal lie then?
So, so the Reserve Bank will look at prospective inflation and make an accommodation for a real interest rate that would speak to partiality with respect to the manner in which it impacts growth and contains inflation. And I would imagine that that spread is in the vicinity of 2 percentage points. So 1 percentage point worth of cumulative rate relief, maybe a little bit more than that in 2024, would give the Reserve Bank that play, barring any significant shock, either exogenous or local, that compels the Reserve Bank to cut interest rates in a rescue situation. And to the extent that we don't have any big shock, to the extent that the Reserve Bank is simply going to cut rates and maintain a steady margin in real rates, and as I said, so that it is partial between suppressing growth, but at the same time sufficient to guide inflation to the central point of the target zone, we can't expect a vicious and extended interest rate cutting cycle over the ensuing quarters.
Goolam, I can tell you that you guys have dampened my spirits, and certainly I think many people would be thinking if we're getting into the cutting cycle, it would be meaningful, and therefore we might get some more relief, but clearly there are a number of factors here at play that will keep rates higher than most people have experienced over the past few years. Unfortunately, we've run out of time, and I have to thank my guests, Annabel Bishop, Chief Economist, Investec, Goolam Ballim, Chief Economist, Standard Bank Group, Carmen, Head of Multi-Asset Strategy at Terebinth Capital. All of you, thank you for your time today.